Investing during an election year. In one of the years that seems to be the craziest we've ever seen when it comes to a US presidential election. And for those of you that have been reaching out to us, asking us, should I wait till after the election to start investing? This video is for you. In fact, this is your one-stop guide to how to invest in the stock market during a presidential election year. Hey guys, it's Aman
and Christina
from Our Rich Journey. Today, we are talking about investing in the stock market during a presidential election year. Every 4 years, Americans go to the poll and elect a new president. And every 4 years, there are people that are so reluctant to invest during an election year because of all the volatility, all of the wild news that comes out during an election. A candidate may say this about the economy or this about a company. Their policies can send the stock market up, down, left, right, or crashing. And so all of this creates fear, the fear of investing during an election year.
So if you are fearful about investing right now, let's look at the numbers and really focus on facts because education is key. So let's actually turn to the historical performance of the S&P 500. We'll use that as a benchmark. Now, during election years, historically, the S&P 500 has actually averaged about 11% returns. Now, this is really interesting because this is actually slightly higher than the annual average return of the S&P 500, which is normally 10%.
Wow, so that's really interesting. 11% during an election year versus 10% on average any given year. But what about after the election? The people that want to wait till everything is settled and the candidate is picked. How does the stock market perform the year after an election? And this is very interesting because on average, the stock market returns 9%, which is astounding to me because all of the folks that said, I'm gonna wait, if you wait, on average, you make less money in the stock market.
So we bring up this information because it can really help you devise a strategy for investing. What we want to focus on now are the key strategies for investing during an election year.
Now, you can have all the information in the world. You could study the history up, down, left, and right. But if you don't have a strategy, that's when things fall apart. The people without a strategy are the people that are not going to get the 11%, the 10%, or the 9%. But it is this strategy that we want to share, that we use, that has helped us invest smartly.
So number one, dollar cost averaging. Now this involves investing a fixed amount at regular intervals throughout the year. This approach helps you reduce the risk of market timing and it takes advantage of market dips, allowing you to purchase more shares when prices are low.
Dollar cost averaging is key to emotional discipline. You see, this emotional discipline helps you stay committed to your investment strategy despite the market's ups and downs, maintaining focus on your long-term financial goals.
Number two, opportunistic buying. If you continue to invest during election years, you could be taking advantage of market dips. Now, historical data from the past 20 years suggests that market dips during election years have often been followed by recoveries, presenting buying opportunities for investors with available cash. So for instance, in 2008, despite the market turmoil due to the financial crisis, the S&P 500 gained 24.2% in 2009 following the election. So we focus on opportunistic buying because like we said, even though during election years, the S&P 500 has historically given an annual average return of 11%, there's still a lot of volatility during those election years. Stocks go up and down very rapidly. So if you continue to dollar cost average, if you continue to invest during those times, you can find a lot of opportunities during that volatility period and a lot of growth after that.
The next key strategy is investing in index funds, diversification through index funds. Now, investing in index funds such as the S&P 500 or the total stock market offers diversification across a wide range of companies and sectors, reducing the impact of individual stock volatility. Now, you can take this diversification even further by considering investing in international index funds. International index funds can give you exposure to global markets, which can provide a buffer against the domestic political volatility that takes place in the US.
Next is sector awareness and sector rotation. Now, there are certain sectors like healthcare, defense, energy. These types of sectors may experience higher volatility during election years due to policy uncertainty. So I'll give you an example. The healthcare sector underperformed the broader market in 2016 due to uncertainty over potential changes to the Affordable Care Act, but it actually rebounded strongly once the policy direction became clearer. So you definitely want to be ready to rotate your investments into different sectors based on expected policy changes.
Now, something else you could consider are defensive stocks. These are stocks in sectors such as consumer staples, utilities, and other areas like this that tend to be more stable and less sensitive to economic cycles. And these types of sectors offer cushions during uncertain times.
Now, we have a portfolio that consists of sector ETFs, index funds, defensive stocks, individual stocks. All of these combined make up our overall portfolio. If you are actually interested in seeing every single thing that we invest in, you should look at enrolling in our 365 Days to FIRE program. It's a year-long program where we help you design your unique FIRE portfolio, including your stock portfolio. You look inside our stock portfolio, see everything that we hold. We also have monthly Q&As. We have incredible meetups over the summer. We have now implemented for 2025 a 2-day in-person conference here in Porto, Portugal. So there's so much that we offer in this program. If you're interested in learning more about it, go to 365daystofire.com, and we'll also leave a link in the description below.
Your next strategy should be rebalancing. Now, rebalancing is all about maximizing profits and minimizing risk. We are huge fans of rebalancing with a purpose, not to time the market, but on a schedule or with specific parameters. So regularly rebalancing your portfolio is done to align with your target asset allocation plan. It captures gains in overperforming asset classes, and it allows you to reinvest in underperforming ones. Rebalancing also helps you manage risks, and it helps you stay aligned with your investment goals, ensuring your portfolio remains diversified and well positioned.
Next, you want to make sure that you stay informed, but also not overwhelmed. So it's really important to keep an eye on key economic indicators and policy changes that might impact your investments. But at the same time, don't get overwhelmed with every single piece of news information that gets thrown at you. You really want to focus on the bigger picture and how it really aligns with your long-term investment strategy and goals.
So one thing that is extra important to do during this time is when you are looking at the companies that you are investing in, make sure to read their quarterly reports and identify any political situations that may be impacting that company's performance.
And finally, you want to focus on long-term value. You want to stay away from those impulsive purchases or those impulsive investment decisions based on short-term political developments. Instead, you want to embrace a long-term perspective by focusing on companies with strong fundamentals, competitive advantages, and quality management. This is really similar to the investment philosophy of Warren Buffett.
And so those are our strategies for investing during an election year. You are going to be experiencing so much volatility over this year. But as we talked about, this could be an opportunity to actually grow your portfolio. Because on average, election years have been great years to invest in the stock market, as long as you have a plan and a strategy. And so if you've liked this video, please give it a thumbs up, subscribe to our channel, and join the journey.